Howard, thank you so much for coming back to Real Vision. It's been just over a year since you sat down with Grant, I think, in Boca Raton to talk to him. So it's lovely to have you back.
Seems like a long time ago, Raoul.
It does. The world has changed significantly. What I'd love to do today, if you don't mind, I'd love to get a little bit of understanding about how you look at the business cycle, and then we'll start to dig in a little bit about going forwards. And I read your recent note about uncertainty, and there's a number of things that I think come out that people are really struggling to think all of this through. And I think there's a lot you and I can look at for that. But I'd love to go back a little bit and just get an understanding of how you look at things, your investment process, and how you use the business cycle, because I think it's one of the key things of what your success, I guess.
Well, I think the key to understanding the business cycle and the market cycle is that most behavior is cyclical and basically goes too far. If we were not subject to excesses and corrections, then everything would hew closer to the midpoint or the trend line or whatever we want to call it. But the point is that the human contribution to the behavior of economies and businesses and markets causes excesses in one direction and then a reversion toward the mean that carries through the mean into an excess to the opposite direction. And these things are not so regular as to be predictable in time or in amount, but they can predictably be expected to happen. And I believe that it is the cyclical excesses tell us what's more and less likely in the future. It doesn't tell us what's going to happen. It certainly doesn't tell us when, but it tells us a lot about what I call the tendencies, the likely outcomes. So, for example, when the market is elevated in its cycle and valuations and psychology are above something we'll call the midpoint, then the next move is more likely to be down rather than up. It doesn't have to be. And from any point in the cycle, anything can happen. If we're elevated in the cycle, we can go still higher, we can flatten out, or we can turn down. And so, where we are and what's likely shouldn't be confused with what's going to happen next. But I do think that where we are influences the probabilities.
Yeah, I mean, I've been a student of the business cycle for the last 30 years, and I find that it gives you a probabilistic framework going forwards.
Right.
And again, there's no certainty within probabilities, but you kind of know, for example, the cycle that we've just finished was the longest on record. So we're all looking for the end of the cycle, because as I think and have identified, at the end of the cycle, future expected returns of most assets end up being negative. And for somebody like yourself who takes advantage of these cyclical